cash out refinance to buy an investment property. If you ever bought a property or considered buying one, you've probably heard of a cash out refinancing. While there are some extremely practical purposes for cash out refinancing, such as home maintenance or additional, a lot of people are unaware that it's also a terrific way to finance a new real estate investment property. What are the advantages of choosing this kind of real estate financing? What can this kind of unique real estate financing accomplish for your wealth portfolio? And what errors should you avoid while using this method of financing real estate? A cash-out refinance on an investment property may provide beneficial loan terms, tax advantages, and the ability to close a transaction swiftly. It is critical, though, that you realize that cash-out refinancing will reset your mortgage clock and considerably increase your monthly mortgage expense. When considering a cash-out refinance for real estate, here are the 3 essential advantages to consider, as well as some potential problems to avoid. But before we continue with the rest of this video, please remember to click the subscribe and thumbs up buttons, as well as the bell notification icon. This way, you'll be the first to know whenever we release new exciting videos. Also, we'd love to hear from you, so please leave a comment in the comment section below. Make sure you watch the entire video, as we will mention a free way for you to win a $20 Amazon gift card. Okay, now let's continue with our video. What exactly is a cash-out refinance? Before we get into the specifics of this kind of financing for real estate investors, it's essential to understand what we're referring to. Cash-out refinancing is a technique to borrow against the value of your house, often a person's most valuable commodity, to get more funds. This financial infusion is often utilized for house repairs, property updates, or even debt consolidation. Moreover, one extremely efficient use for cash-out refinancing is to fund real estate ventures. The investors pay off the current mortgage with a new loan conditions, keeping the money in cash. This fresh stream of cash may then be put toward either improving an existing property or acquiring a new property. Why should you use a cash-out refinance? According to Chris Miller of Dough Roller, attractive interest rates can be obtained through cash-out refinance. If you're strapped for cash but have value in your house, refinancing opens you a new source of funds for home upgrades, college tuition, and other long-term ambitions you may have. However, this is a hazardous course of action, and it's worth investigating whether or if there is a better choice. There are various reasons why cash-out refinancing may be the best financial solution for you. Stay tuned to learn about the benefits of using cash-out refinancing, including lower interest rates and faster approval processes. Number 1. Tax advantages. This may be the most significant advantage of adopting cash-out refinancing for real estate reasons. Therefore, as of this video, the interest on a cash-out refinance is tax-deductible, as is the majority of the closing expenses involved. This is not always the case when borrowing money from a bank or private lender outside refinancing, though it varies depending on the sort of company structure you have in place. The interest on the loan you've obtained to support your investment is often not tax-deductible. This is within the context of refinancing, though many investors, even when they have available resources, choose to employ this strategy to obtain funds for investments. Number 2. Low interest rates. What's the big deal about withdrawing funds from your house to purchase an investment low-interest property? One of the most significant benefits, the loan's interest rate. Historically, a mortgage will provide you with a substantially lower interest rate than borrowing the same amount from a bank or hard money lender. It's worth noting that cash-out refinance loans often have lower interest rates than home equity loans, which are typically used to pay for large-ticket necessities like medical expenses, home upgrades, or college tuition. When applied to real estate, cash-out refinancing may save you thousands of dollars more than borrowing the same amount from other sources. Number 3. Agility. Our most important possession is time. Whatever cash-out refinance may give a would-be investor is the opportunity to jumpstart their real estate investment career without having to wait months, if not years, to save up enough money to make their first transaction. Maybe you've been putting money aside in your bank account or thinking about dipping into your 401k retirement account. Perhaps you've even gone out on the town seeking to attract the attention of private lenders to your enterprise. This path will only require a large amount of work and time, but will also drastically slow down your growth as an entrepreneur. Using a remortgage in this manner may frequently be a game changer in your company and working life, as long as you've done your study and have a strong understanding of the investment industry. The disadvantages of cash-out refinance. There are certain disadvantages in considering cash-out refinancing to invest in real estate in this method. The most apparent but significant negative is that you are raising your monthly mortgage payment. If anything were to happen to you, such as losing your job or being wounded, your mortgage may become too much to bear and you could lose not only your investment but also your property. Another potential disadvantage is that you may end up owing more on your initial home with this increased principal to your mortgage than the property is truly worth. If you've performed your research and know your market, this is unlikely, but it's still worth remembering. Perhaps most importantly, depending on the circumstances, a cash-out refinance will reset your debt. If you've been paying down your mortgage for 10 years and have just 10 years remaining, a cash-out refinance will reset the clock, giving you another 30 years to pay off the loan. This isn't usually an issue as long as you've planned for it. However, before making any investment, it's critical to understand precisely what you're dealing with. Timelines for cash-out refinance. If you want to utilize cash-out refinancing to fund your repair project, you should anticipate a waiting time. The duration between a home closing and the moment at which you may utilize your cash-out refinance is 6 months. There are unfortunately certain exceptions to this rule. If you inherited a property, the property was awarded due to divorce or legal separation, or cash-out refinance is considered for the delayed financing exemption, you may avoid the cash-out refinance waiting period. Do you qualify? When compared to a regular mortgage, cash-out refinances often have greater qualifying standards. It is reasonable to assume the following qualifying requirements. Credit score. Most lenders might need a credit score of 650 to 700. However, this will change depending on the loan. Cash reserves. Lenders will want to determine how much money you have available outside of the refinance loan, which is referred to as your cash reserves. Lenders may need between 2 and 6% of the loan amount in a separate asset account when granting a cash-out refinance for a financial asset. Waiting period. Normally, anybody who wants to use cash-out refinance must wait at least 6 months after purchasing the house. Equity. Before you may tap into a property's equity, you must first build it up to a particular proportion. Lenders will normally want more than 25% equity, although the actual amount can vary. If you're thinking about doing a cash-out refinance for an investment property, the smartest thing you can do is to check out several lenders. This will offer you a better understanding of whether or not you are qualified, as well as assist you in determining the best loan terms. Most lenders will want to know the same things about your financial situation, but others may be more ready to work with you nonetheless. HELOC versus cash-out refinance. Cash-out refinancing is one method for assessing a property's equity. Another is a home equity line of credit, or HELOC. The main difference between the two is that a cash-out refinance delivers a lump sum payout, but a HELOC enables you to draw on the equity as needed. A HELOC is similar to a credit card in that investors may borrow again once the loan is paid off. There are a few essential aspects to consider when selecting between a cash-out refinance and a HELOC. Importantly, HELOC interest rates may be somewhat higher. HELOC loans for investment properties may also be more difficult to get, while investors can still use their principal property. A cash-out refinance, on the other hand, may have a lower interest rate but may also increase the duration of the house loan by 10 years or more. We hope you enjoyed this video. Again, don't forget to subscribe, like, click the notification bell, and leave us a comment below. We love to hear from you, and we'll be doing a random name drawing of the first unique 100 commenters who also like the video and subscribe to the channel. The lucky winner will get a $20 Amazon gift card. So get involved and don't be shy.